Okay, picture this. You wake up at 45 years old, you look around, and you realize you're still trapped in the exact same cycle. You know the one. You're working harder, you're earning more, yet somehow you're still falling behind. Why does that happen? Well, it's because while you're out there trading your precious time for money, the wealthy, they've figured out an entirely different system. They're making their money work for them. Today, we're going to unlock exactly how they pull that off. Okay, let's dive right into this. So, what is the single riskiest financial decision you can possibly make? Now, if you're a beginner, you probably think the answer is, investing in the stock market. But before you close this explainer thinking stocks are just gambling, or that you need thousands of dollars just to play the game, or that investing is just way too risky, I really need to challenge that assumption head on. Because honestly, the shocking reality is exactly the opposite. The absolute riskiest decision you can make today is not investing at all. Why? One word: inflation. It's this quiet, invisible thief that literally steals your future purchasing power every single day. If you just leave your money sitting in cash under a mattress or in a basic savings account, you are mathematically guaranteeing a loss over time.
Section 1. The cost of doing nothing.
It comes down to a really stark comparison. On one hand, we have trading time for money. This is the path of the consumer, right? And it's a path of financial stagnation because, let's face it, your time is strictly limited. There are only so many hours in a day you can actually work. But on the other hand, we have making money work for them. That is the path of the wealthy. The fundamental difference between the broke and the wealthy isn't necessarily intelligence or even having some massive salary. It's figuring out how to transition from trading your time to actually making your money do the heavy lifting for you. And the ultimate tool for that transition is the stock market.
Section 2. How the market works. At its core, the stock market is simply a marketplace where people buy tiny pieces of ownership in a business. That's really it. It's not a casino. When you buy a stock, you're literally buying a fractional piece of a real functioning business. You see, the wealthy don't just clock in and work for companies. They actually own them. And the beautiful part is, if that business grows, your investment grows right alongside it. And this brilliantly illustrates how powerful long-term ownership can be for building wealth. Think about Amazon. Imagine buying a piece of Amazon back in 2001. Back then, people actually thought, why would anyone buy books online? It was super awkward, totally unproven. But if you had invested $10,000 back then and simply held on to your ownership as the business expanded over the decades, that investment would be worth hundreds of thousands of dollars today. It's wild. That is the incredible, exponential power of long-term ownership. But of course, the journey isn't a perfectly straight line up because stock prices move based on human emotion. Fear, greed, hope, panic. The market is basically humanity's emotions with numbers attached. And honestly, the irony of human behavior is pretty wild. Think about it. People will happily hold on to a toxic relationship for 5 straight years, but they will totally panic and sell everything after seeing their stock drop just 7%. We are absolutely fascinating creatures. The market rewards patience, but we've been so conditioned to expect overnight success, and that emotional panic just completely destroys portfolios. Section 3. The index fund secret.
If you remember only one thing from this explainer, let it be this. Most beginners should start with index funds. Instead of betting on one single company and just crossing your fingers hoping it does well, you buy an index fund. That's essentially a basket of many powerhouse companies all bundled together. Take the S&P 500 index fund, for example. It holds heavyweights like Apple, Microsoft, Google, and Amazon. So the crucial point is that you're buying the entire market. If one of those companies struggles, the others in the basket help balance the whole thing out. It's like having a built-in safety net. Even Warren Buffett, literally one of the most successful investors in human history, recommends this strategy. His philosophy is perfectly captured by the phrase, consistency beats intensity. You don't need to be some sort of financial genius who finds the next overnight sensation. You really don't need a hot stock tip from your neighbor. You just need a system that survives decades, fueled by steady, unwavering, and entirely unglamorous habits. Let's move to section 4 and see how this builds into the biggest beginner mistakes. Okay, there are 3 massive traps you need to avoid. Mistake number 1, trying to get rich quickly. The market brutally punishes impatience. People see an influencer making millions overnight, they try to copy it, and bam, the crash comes. Real wealth is usually built quietly and invisibly. Mistake number 2, investing emotionally. Buying when everyone is hyped and selling when everyone is terrified. That is exactly backwards. The wealthy actually buy during fear because fear creates huge discounts. And mistake number 3, which is probably the deadliest of all, waiting too long to start. Listen, time is vastly more important than money. A 22-year-old investing small amounts consistently can easily outperform a 40-year-old investing huge amounts simply because they got off the sidelines and started earlier.
Now, what's really interesting about this is how we fundamentally redefine risk. Beginners think risk means the stock market dropping and them losing money. But real wealthy investors, they define risk entirely differently. To them, risk is losing purchasing power by doing nothing. Keeping your money in cash feels super safe, but a dollar today will absolutely buy less tomorrow. That's a fact. Wealthy people embrace controlled risk in the market because doing nothing guarantees a loss to inflation. Yes, markets crash, but historically the market has always recovered over time.
And here is where we completely destroy the biggest myth keeping you from starting. You know the one. I'll invest once I make more money. The cost of a few coffees. That is literally all you need to begin today. Modern investing apps allow for something called fractional shares, meaning you can buy tiny pieces of super expensive companies for just a few dollars. The habit matters so much more than the initial amount. You start small, you stay consistent, and you automate it. Automation removes the emotion, and I promise you, the less emotional your investing is, the better your results are going to be.
Section 5. Time, compounding, and freedom.
The greatest weapon in the stock market isn't stock picking at all. It's simply time. Time allows compounding to work its magic. Albert Einstein allegedly called compounding the eighth wonder of the world. And it makes sense. Compounding means your money earns returns, and then those returns start earning their own returns. At first, the growth feels painfully slow, kind of like watching paint dry. But suddenly, it accelerates spectacularly, like a giant snowball rolling down a hill. This massively rewards those who start early, and unfortunately punishes those who spend their 20s merely consuming.
And that brings us to the ultimate truth. The true goal of investing isn't just a big pile of money to swim around in, it is freedom. Wealth eventually stops being about luxury and starts being about ultimate control. Control over your time, your schedule, and your future. The stock market is simply the tool that buys your time back. So I'll leave you with this provocative challenge. Will your future self thank you or deeply regret waiting? Don't just consume this information. Stop watching, take control, and become an investor today.